Hey, it's Ryan from Parse Money Research and the Option Income Advisor. And today I'm going to talk to you about just my thoughts and theories and perspective on the general market. It's important to do this from time to time because I know we get so caught up in on a daily basis of, building our watch list of stocks, trying to find, those consistent option opportunities where, we're selling puts with a margin of safety. And we get so caught up in that perspective. I think it's important to take a step back every now and then and just, kind of build your theories on what you think the market's going to do in general, because even though we're kind of trading these options short term and our perspective on stocks as we build our watch list anyway is that if a stock's going to make our watch list, we actually like the long-term perspective, of that company, business model, et cetera. So, we do have a long-term perspective on the stock, but we do have a short-term perspective on the movement of the stock, over the short term. And I think it's important, again, just to, maybe once a month, just take a little time out of your day to, research, the general market and build your perspective and your thoughts on that, because I think that will dictate it. And it's so easy to go out and find, articles that say one thing or another. I mean, if you're looking for a market crash and you type in market crash, you're going to find a bunch of articles that back up, a potential market crash coming, and vice versa. You can find, bullish perspectives as well, but it's important for you to have your own. And I like to keep things very simple and kind of high level, as far as, my thoughts on the general market. And while I do think valuations have pushed to kind of high levels here, I think you've got a lot of tailwinds still behind this market. And so, today I'm going to talk just about three kind of broader reasons why I think, the market's not going to have a significant correction this year in 2021. So that can kind of lay the foundation of, how we trade and manage the portfolio for the rest of the year. If we believe that, the market's not going to have a big correction, maybe it has a 5 to 10% pullback, which is normal. But those opportunities will be buying opportunities. And so as you're setting your levels, with cash secured puts and your margins of safety, keep in mind that, hey, the market could trade a little bit lower, but, these trends are in place to probably keep the market churning or keep it stable, through the end of the year. And so again, I think it's important to have those perspectives. So I'm going to talk about my three top reasons today. I'm going to show you a bunch of charts and kind of walk you through everything. And, this is stuff that you can come back and listen to, several times, if you want to listen to it now and then, kind of just refresh your memory of some of the things we talked about, a few months from now. So you might want to bookmark, this video, but, this is, I think it's just important stuff to have, a high level general market perspective. So the three things I'm going to talk about today is one, you still can't fight the Fed. The Fed is still in charge. And I think if the last kind of 18 months has taught us anything, is when the Fed's driving the boat, it's really hard to go against them. And so there's still tons of liquidity out there. There's still, interest rates are still low, and we're going to look at these charts because interest rates are probably the biggest risk that I think the market has. So I'm going to show you some levels and some ranges that I think if the interest rates stay, within those levels, I think the stock market will be okay. The second reason is that you have all these big institutions that are big, long-term, stable holders of stocks, and they really have no incentive to sell right now. And in fact, you could make the argument that given what's going on with potential bond yields going forward and bond returns, that they may actually increase their allocation to stocks because they have to earn a return, right? That, these big pension funds have to earn, 6-7% a year just to hit their hurdles. And, when bonds are, expected to, and we're going to look at some of these expectations, in some charts. When expectations are low for bond returns and you've got that added inherent interest rate risk, I mean, the bond part of your portfolio is not going to have the diversification benefits that maybe it has historically. And so I think there's incentive for institutions to continue to hold stocks and maybe even increase their position, right? Until these big holders, because there's only so much market cap, in the stock market in general. And if you've got big institutions holding and not selling, until those institutions are ready to really sell, like real sellers come to the market, I just don't expect a big crash. We'll have volatility, but I just don't expect a big crash. And then the third reason is, the market indices, the large indices in the U.S., the Dow, the Nasdaq, and the S&P are all in very strong uptrends. And we're going to look at the charts and we're going to look at these levels of where I think, realistically those indices can pull back and still keep their trend in place, right? So I think those three things are key. We're going to look at a bunch of charts today, so kind of bear with me, but I think I think this is just good stuff, just to kind of look at and have perspective on. So let's look at some charts. The first charts I want to show you are the 10-year Treasury. So again, I think interest rates have it's the biggest risk, I think, to the market. I think when interest rates finally do start rising and stay at a heightened level, I think that's when the market has the potential to sell off and kind of stay and consolidate in that area. Because what's happened is we've got market multiples expanding, right? So everyone talks about how valuation has gone up and the market's overvalued. Well, is it really overvalued at this time, given the backdrop of low interest rates, the Fed still providing liquidity, and corporate earnings increasing, right? The market multiple actually peaked several months ago because as even though the market has continued to trend higher, the corporate earnings have come in and have actually been very strong, and so that denominator of the PE ratio is increasing more than the price has, and so your market multiples actually come down. Yes, it is a little bit inflated still, but again, with the backdrop of having low interest rates, it may not be that expensive as you think, right? But you can look at situations like we had just earlier this year, where so the purple line here in this chart is the 10-year Treasury rate. And so I would say just even just starting at the beginning of the year, so kind of year to date, you could see, we increased basically from about 90 basis points all the way up to about 175 basis points at the peak. So, pretty much doubled the yield of the 10-year Treasury over a few month period. And what that does is that it kind of makes you revalue some of these high multiple stocks, because these high multiple stocks have been trading at high multiples because the interest rates are so low, and because they're consistent cash flow generators, that as you discount these cash flows, a true kind of valuation, DCF metric, you're discounting these cash flows at a very low interest rate, so it makes the value of those businesses higher. But as the interest rate goes higher, the value of those cash flows go down, and so you shouldn't be willing to pay such a high price. So what you saw during this period, and because it spiked so quickly, it really ignited fear amongst all these high multiple kind of stockholders. And you can see this is Apple. So Apple, again, is a good metric for the market as a whole. Apple sold off almost 20% during that time frame, and you can see this inverse relationship between Apple stock and interest rates, right? So as interest rates started to come down, right, because we went from 175 basis points down to about 120, you can see what happened to Apple stock. It went up, right? And so I think you're going to continue to see that inverse relationship and that dynamic as interest rates fluctuate, right? And so, let's look at, just a couple other stocks we'll just add, to this list. So Tesla, again, one of those high multiple stocks, right? Again, the purple line is the 10-year Treasury, and the orange line is now Tesla stock. You can see it had the same dynamic, right? Tesla actually sold off about 35%, 36% as interest rates are rising, right? And then it kind of just hunkered around and stabilized a little bit, but it has kind of picked up. But this stock, it hasn't even picked up as quickly as say Apple has, right? But it's certainly starting to trend a little bit higher now. So again, something to watch. One kind of ETF that's always in the news with perspective to just being high multiple stocks is Cathie Wood's ARK Innovation ETF. So we've got same thing here. Purple line is the 10-year Treasury, and here's the level of the ARK ETF. So this is kind of sold off, right? This one sold off almost 40% from peak to trough during that rise in interest rates, right? And has since come back, right? So you're still seeing that inverse relationship, but you can see now this one's almost kind of trading a range, right? So this one, maybe like kind of predicting that interest rates, are going to continue to go, a little bit higher here, right? So, we have jumped from 120 basis points up to 136. So we have had a pretty strong move recently, but I think it's probably a good sign that this stock is consolidating a little bit. But I would expect if interest rates stay here, you could probably see ETFs like this kind of trend higher, because again, I think the real risk of these high multiple stocks in general, and then the risk of the market as a whole that has a relatively high multiple is whether or not interest rates stay stable or not. So I think that's the big number one reason. And again, I said, the Fed is still in charge, right? As long as the Fed doesn't go crazy and, raise interest rates too quickly, which I personally think they're going to keep interest rates low for several years, right? And so they have started tapering a little bit. You hear about the taper tantrums, and, really what that is that it's their asset purchase program that they're just pulling back on. And they've already started doing that. But, as they start to pull back more, and really what the asset purchase program does is it floods the markets with liquidity, right? And so liquidity has been very strong out there, and I think it'll continue to be strong. And I don't think the Fed's going to do anything. They worked so hard, I think, to get everything back on track. The last thing they want to do is go too fast and pull back too much on the taper and take liquidity out that maybe should still be in there, right? So I think they're going to make very measured kind of decisions going forward, and so that's why I'm not too concerned, because even though they're tapering, there's still a ton of liquidity in the market from their asset purchase programs, and so that's why I think that as long as the Fed is still in charge, if you're a bear, I would not be fighting, this market going forward. And so, I want to show you. So here's just an annotated chart of the 10-year Treasury rate. Again, we're right around 1.3%, and I think what we want to see is stability, right? And so, and this is not me just pulling random numbers out. I mean, I've done a lot of research of analysts that have talked about what's the level of interest rate that causes concern and would cause the market to sell off again. So we peaked around 175 before, and then this 125 level seems to be where we're kind of consolidating on the low end, right? And so the thought is, if we can stay within this range, like there's an optimal range of low interest rates, which I think, this 125 to 175 range makes a lot of sense. As long as we don't go too far above that, or, certainly stay below that, which would be ideal. The risk of huge market sell-off, like we saw before, where, multiples contract, is probably low, as long as we can stay, underneath that kind of threshold. Vice versa, if the interest rate goes down, because in theory, right now, with the Fed potentially going to raise interest rates in the future, I think the last thing you want to see is interest rates to go lower, because that signifies that maybe there's some underlying issue, that no one's talking about or seeing, in the market that is cause for concern. So again, if the interest rates go too low, I think there's cause for concern as well. So I think we really need to play it safe and hopefully get some stability, within this kind of 50 basis point range. And I do feel like the Fed has some targets in their mind. I'm not sure if these are their targets or not, but I think it makes sense to kind of watch these levels, and just kind of watch how this, how the interest rates kind of move, over the next 3-4 months, through the end of the year. So this is the key to the whole market, I feel like, is interest rates and how the Fed's reacting. And as long as these rates are stable, I think you cannot fight the Fed. So that's reason number one. And you can see how those stocks, those really kind of active, widely held stocks, have traded with interest rates. So, certainly keep that in mind. But this is the range that I'm certainly looking for. So number two is, there's nowhere else for institutions to go, right? So I want to show you some interesting kind of asset return expectations. So this is from BlackRock. This is their website. You can actually just go to blackrock.com and or type in BlackRock asset returns, and you'll find this link. So it's interesting, right? BlackRock is the largest, one of the largest institutions in the world as far as managing money. Huge bond portfolios, huge stock portfolios, and so they come out with their expectations for different asset classes, for the next 5, 10, 15 years. Into the future, because it's very important as an institution, right? They're always trying to manage risk and reward of the portfolio itself, utilizing the various asset classes that they have at their exposure, right? Traditionally, stocks and bonds, obviously commodities. Lately, you've got alternative assets. So over the last 15, 20 years, you've had a situation where, they've increased their private equity exposure because, and this is a topic for a different video, but in theory, private equity has, very high returns compared to other asset classes. Granted, they're completely illiquid, and so there's no way to kind of mark those portfolios to market. It's kind of like whatever the private equity firm says it's worth at that time, you really don't know until they exit, their investments, and then they realize the return. So, there is some, I think, playing with the numbers a little bit with as far as what their expectations are. But if you look at private equity, it's got a very high return expectation compared to really any other asset class. So this private equity is up here on top. And you can see there the expected return for private equity is almost 20% compared to again I think these red lines up here, these orange lines are alternative assets. All the green lines here are equity assets, and then all of the yellow are fixed income. And you can kind of just see how it goes from higher returns really down to no or negative returns, as you look at the different asset classes. So what I think is important, and let's actually, they have some different graphs down here, which I think are good if you just kind of scroll down. So this is a plot chart. So again, you can see where private equity is way over here, and you just kind of see where some of these you've got expected annualized return here on the left axis, and then on the bottom axis you have volatility. So this really gives you a sense of risk and reward of what they feel these different asset classes are gonna provide. And then down here it actually shows you the actual numbers, right? So this is kind of what I want to get across, that if you're a big institution, right, say a pension fund, for example, that has to earn a 7% a year to kind of hit their hurdle. Well, historically, they've been able to do that, right? We've had decent equity returns. Bond returns were pretty good historically. But now it's kind of all flipped, right? Where you've got this crazy situation with bonds where you've got ultra low expected returns, but an abnormal amount of risk over the short term that interest rates will rise and your bond portfolio will actually suffer pretty badly, right? So if interest rates rise, we've already seen that stocks could be at risk potentially, but bonds are certainly at risk as well. So you're not going to have this diversification benefit that we normally have, right? So as these institutions are looking at their portfolios, they've already increased their exposure significantly to private equity, right? Their private equity, I want to say I saw a stat that just large institutions in general, used to be in kind of the 5 to 10% range of private equity, but over the last 15 years, a lot of these institutions have moved to 20% plus exposure to private equity. So I don't think there's much more room to move there to where they can add more exposure to private equity. So really what you've got, if you're moving away from bonds, you really kind of trying to justify why it makes more sense to own stocks. So at a minimum, I don't think they can afford to sell their stock exposure because they need it, right? And kind of back what I was saying before, unless these big, strong holders of these equities are truly wanting to sell and depart from their positions, I don't think you have a major correction, right? I mean, you're going to have volatility and pullbacks and things like that, but until these large institutional holders of these stocks are willing to sell their positions and flood the market with sell orders, I don't think you get a major kind of crash situation. And in fact, you could argue, I guess before I move on from this, you can see the two that stand out for me the biggest is U.S. high yield debt. Think about this: corporate high yield debt is literally only expected to return 2.5% over the next 5 years. I mean, that has got to be one of the most worst risk-reward situations you could imagine, right? Yes, there's a lot of liquidity in the market, and corporate balance sheets seem to be strong right now, but getting 2.5% when historically you should almost expect that from like a risk-free 10-year treasury, right? These are high-yield junk bonds essentially from corporations, and then you got emerging market debt, only less than 3%. I mean, these are risky fixed income asset classes that are just not expected to return anything. And then when you look down here towards some quasi risk-free stuff, I mean, they're literally expecting U.S. government credit and U.S. credit in general to have negative returns for the next 5 years. So you can't be a holder of this and still get to your 7% bogey if you're an institutional investor. So how do they justify from a risk perspective taking on more stock? Well, I think there's argument that there's more risk in bonds now, right? And I think as they're looking at their portfolio as a whole, a lot of these guys use a metric called value at risk, and value at risk is really just it's a measure that kind of isolates how much potential capital you could lose based on different volatility assumptions and things like that of an asset class or as a portfolio as a whole as they move together, right? And so they really look at this value at risk. And so one of the big metrics, right, that we follow and one that they follow as well that goes into this value at risk calculation is, let me flip over, is the VIX, right? So we've all seen, or follow the VIX as an option seller, right? We like it when VIX spikes a little bit because we get more premium. But there's also a scenario where if the VIX stays low and stable, it's also a pretty decent environment. You don't get as big of margins of safety as you normally would, but you also have a lot less volatility realized, in situations like that. So I would actually, scroll out even further. So this huge spike you saw was obviously during the pandemic. I mean, I don't know that we'll ever see a VIX of 80 again. It just unprecedented. But you can see prior to that, this VIX level of say 36 was kind of almost as high as it would go, right? It'd pop up to 40, every now and then, but you'd get these big spikes, but then it'd come right back down. And this level of 20, which is the dotted line down here, that's kind of the level that most, I think portfolio managers and just market participants look at and say, well, if the VIX is below 20, we're really expecting, kind of a muted market environment, or at least a normal market environment, right? As the VIX is below 20, like meaningfully below 20. So you can see, there were years here, 16, 17, 18, where, the VIX hit a low of like 8 or 9 and just extremely low, volatility, in the market. And really that's how it played out too. We went, until, January. Well, actually, there was a little blip in early 2018, but then at the end of 2018, you probably recall when Powell was out talking about interest rates, and the market literally sold off like 20%. So that was this kind of spike here. But prior to that, very low kind of interest rate environments. But what happens with these value at risk measures? So sometimes it doesn't necessarily force institutions out of stocks. But they're certainly not buyers, I think, when volatility spikes and some of these, value at risk measures kind of start moving and going a little bit haywire. But as the VIX starts going lower and their models are updated for low implied volatility, they can actually justify putting more stock position on, because in theory, if the volatility is low and we get low realized volatility in stocks, well, you can earn an outsized return in the stock market. And if the volatility stays low, that kind of is a good combination for their value at risk measure, right? So they can actually justify, from a portfolio perspective, putting on more stock positions, or at least keeping them stable, right? So that's kind of the situation we're in now. So if we go out of that long-term chart and kind of scroll over to the shorter term. So this is, again, this is just kind of literally the last 12 months of kind of VIX movement. And so you can kind of see we keep making, we have spikes every now and then, but the funny thing is these little spikes right here that we've seen have really only been about 3 to 5% pullbacks in the market. So you see these really short-term spikes, but you can see we're making higher or lower highs, in the VIX, which obviously signals, that volatility is kind of, coming down. And now you can see that we're kind of hovering around this, below 20 again. And so if we sit below this level and just kind of bounce around between 15 and 20 for the rest of the year, that's a perfect scenario for these institutions to justify owning more stock, and certainly not sell stock, right? So that's my number 2 big reason, right? Interest rates stay low, volatility stays low. There's no incentive for a big institution to sell because they need the return. There's nowhere for them to go. They can't just sell their stocks and buy more private equity, and they can't just sell their stocks and buy more bonds because the bond, portfolio or expected returns are awful, right? So there's nowhere for them to go, and if there's nowhere for you to go, you can't go to cash, right? You can't earn your return in cash, so they've got to be in some asset. And I just think there's going to be stability from this dynamic in the stock market, because I think that's where they need to be, right? So the third thing we're going to look at today is just the trend, right? So you guys hear a lot about, and when we're looking at individual stocks, I like to look at the trends because it's meaningful, right? As stocks pull back, ideally you'd like to have that individual stock being an uptrend, and you'd like to catch maybe some of the dips, in a strong uptrend, right? As a stock goes from an uptrend to a downtrend, it's harder to predict the levels that you would feel comfortable with, because you really don't know, right? If you're in a downtrend, you don't know how low it could go. But in an uptrend, it's more meaningful and measured when you can see dips, right? And as long as the long-term uptrend stays in place, you feel pretty good about it. So let's look at the 3 major indices, the S&P, the Dow, and the Nasdaq. And so let's just look at like a 1-year chart here. So again, these are high-level things. I'm not getting too detailed here. This is very simple, stuff, right? We have a long-term moving average, which is the 200-day moving average, right? We've got a shorter-term moving average, which is a 50-day. So the 50-day is the blue line. The 200-day is the pink line. So that's a longer-term moving average and shorter. So the shorter one is always going to be a little bit more volatile. But when you see a situation like all these indices are in, where you've got the 50-day or the shorter moving average trading above this 200-day or the longer-term moving average, it signifies that this is a uptrend, right? This is a strong uptrend. The shorter moving average is trading above the longer one, and it's got a consistent kind of margin right in between there. You feel pretty good about it. And on top of that, when you see the price level of the asset trading above the 50-day moving average, again, strong uptrend. So when you've got the price above the 50 above the 200, and it continues to kind of move higher like that, it's just a very strong uptrend. And these are trends that aren't easily broken, right? These are slow moving trains, right? This is a Freightliner, right? You don't want to step in front of it, because it takes a while for a trend like this to break. And so as I'm looking between now and the end of the year, I don't see a scenario necessarily outside of some crazy geopolitical thing, or I don't even think COVID will throw this thing off. I mean, if you think about what happened with the Delta variant over the last month or so, if that doesn't spook the market, I don't see a scenario on the COVID side that because I think things are moving in the right direction there. We're getting a lot of vaccinations. The people that aren't vaccinated are potentially catching this variant. So I think we're getting to a point to where we're probably getting close to herd immunity, right? And so I don't see a scenario from that perspective, throwing the market off either. So you look at these strong uptrends and you don't want to fight it. Like the trend is your friend, and you gotta kind of just kind of go with it. So you can see the S&P more so than the other indices has actually been very, very consistent. Every time it's traded down to its 50-day moving average, it kind of pops right back up. And again, like I said, we've recently just had these kind of 3 to 5% dips, but every single one of them has been bought up, right? And that is the scenario. Given the first two reasons I talked about, right? You have an accommodative Fed that's keeping interest rates low. You've got strong equity holders that have no incentive to sell, and in fact have an incentive to increase. And then you've got a market that looks like this. Like what would make you want to sell, stocks into this market, right? I think you just hold, and we're setting ourselves up for a real kind of buy the dip scenario again. And when I talk about, I don't think there's going to be a crash or correction, I'm saying I don't think there's going to be a meaningful 10% plus decline between now and the end of the year. Will we get some more of these little blips where we've got 3 to 5% pullbacks, maybe even up to 10%? Maybe. But if you look at all of these charts, right, and I think this is kind of key, it would be big for these things to break through their 50-day. So S&P, for example, is about 3% above its 50-day moving average. So totally reasonable for the market to pull back 3%, maybe even a little bit further and dip down below that. To get down to this 200-day would be a pretty meaningful pullback, but it's a really strong level of support, right? So if we did for some reason pull back, 10%, and we start, bumping up against this 200-day moving average, I think absolutely, as long as those other two things are in place that I'm talking about, you're going to have a major buy the dip scenario. But I think the buy the dip happens way before, we hit that level down there. Same thing for the Dow. So you can see the Dow is actually dipped a little bit more meaningfully below the 50-day, which again is normal. Here it was pretty good, and here. But you can see it dipped a little bit lower here. And really what happened, the Dow is more industrials, right? So we've had some really major swings in cyclical stocks recently. So this is kind of when COVID, the Delta variant started coming out, and people were having second thoughts about the reopening play, right? All these, industrials and cyclical stocks, you're having second thoughts. So that's why you're seeing a little bit larger dip here in the Dow. But again, it's each time it's popped below there, it hasn't stayed for long, and it's popped right back above the 50-day. So now we are about 2.4% for the Dow above our 50-day, and about 8.7% above the 200-day. So again, could I see a scenario where maybe it pulls back if we have a really big pullback, I put big in kind of quotes because that's not even big from a historical perspective, but with a trend like this in place, I think any pullback between the 50 and 200 day probably get bought up before it gets down to the 200 day moving average. But it makes you feel comfortable that even kind of a worst case scenario that you can think of right now, where a strong uptrend like this gets support at the 200 day, you're only talking about an 8-9% pullback, right? Which again, in historical standards, that's a normal thing that happens every year, right? So the whole point is to not get too caught up in, do I need to sell everything? Do I need to be cautious, with what I do? Well, when we're selling puts, we typically have more than a 10% margin of safety anyway, right? So this is the kind of scenario that makes you feel really good about the margin of safety that you've got there, right? Because if you've got a 10 to 15% margin of safety on every single position you have on, you can sustain these, and sometimes you may not get filled on hardly any stocks at all, right? You may get filled on a couple, but again, I love this long-term trend that's in place, and just the dynamic that we have multiple levels of support here. So last one we'll look at is just the Nasdaq. Again, Nasdaq way more susceptible to swings in interest rates. So those charts that we just looked at on the interest rate front, this is really what you're seeing here. So these high growth tech stocks have had some pretty meaningful swings, just over the last couple months, right? This was the big one where the interest rates rallied up to about 1.75, and then we had another kind of little scare here. But you can see since, and even as interest rates have come up off their bottom, you've got a scenario here where the Nasdaq and these growth stocks, if interest rates stay within that range that I kind of highlighted, I think it's a great scenario for this, right? So again, I don't see a reason why this uptrend should not be in place as long as we those first two scenarios that I talked about will kind of be in place, right? As long as we've got the accommodative Fed, as long as interest rates don't get crazy and kind of stay in that range, you've got a scenario here that makes a lot of sense. And so just to look at the numbers, you got the Nasdaq about 2.3% above its 50-day, and then only about 9.3% above its 200-day. So again, I really just feel like any pullback in any of these indices between the 50 and 200-day moving average between now and the end of the year will be buying opportunities. I think we'll see that. I think we'll see a kind of muted VIX. You can already see it with that VIX chart. I don't think there's any reason that kind of downtrend, will kind of move out of that range. And you keep a VIX below 20. I think you've got institutional buyers that will continue to not only just hold their positions, but potentially add to their positions, which again would just be more kind of tailwinds behind this market. And on top of that, we really didn't, show a chart or anything. We talked about this a little bit at the start of the video. You got corporate earnings that I think will continue to increase. I think as we get to full reopening, with the economy, and I think we're pretty close. I really think with the vaccines and this Delta variant, causing more infections, you got less people dying. So you got more people with natural immunity, more people with vaccinated immunity. I see a scenario where we reopen. All of a sudden, you've got people traveling more. You've got the leisure stocks doing well. You've got maybe interest rates going up a little bit. So you got financials doing well. You've got all the other cyclical industries like industrials and materials doing well. It's a scenario that worked great for tech. As long as interest rates stay within that range. So. Again, I'm not looking out 5 years from now, but I'm looking out the next 6 to 12 months. And, this just seems like it's going to be something that stays in place. And I just think the Fed worked so hard to get to where it's at right now that it would just be silly for them to, go out and do something that causes instability in the market. I just think they're going to be watching it closely, and It's just something you can't really fight right now. So that's my high level take. You can agree with it or not, but that's kind of my take on the market. These are simple charts to follow. I think it just sets up for a great environment. Because even though we may not keep marching higher, will this trajectory that we've seen this year, where the S&P's up 19%, the Dow's up 16%, the Nasdaq's up 15%, year to date through August 15th, are we going to continue to see a move where the markets go higher? Maybe not, but we have a scenario where we're just chopping along, for the next 6 months. Phenomenal environment for selling puts in the triple income wheel. So that's kind of what I'm looking at, and I think it's just setting itself up really nicely. So we'll continue to do our trades of the day, and give you the perspective just on again the website and the platform, and how you can utilize the platform better to find good opportunities consistently and implement it. But I think it's important to have this high level backdrop of just the general market. So hopefully you appreciate it. Any questions, as always, I'm here to help. Feel free to email me, and take care.